Welcome to HowtoFinancial and our video on the origins of money. In this video, we will be discussing the history of the bartering system, hard money, fiat currency, full reserve banking, fractional reserve banking, and the difference between money and currency. The bartering system. This is the oldest form of trade known to man, and it's when you trade your chicken's eggs for someone else's cow's milk. But let's be real, bartering can be a real pain. It's like trying to find the perfect match on a dating app. You might have what someone wants, but they might not want what you have. And how many of your eggs equals a gallon of milk anyway? It's all up for negotiation. Instead, we invented money. Money is something of an established value that can be traded between people, that is easier to carry around than what you would be bartering for, and can be exchanged for any product or service. And if you happen to run out of your eggs, but still need to feed your roost of chickens, and you have money left over from your last sale of eggs, you may be able to buy some chicken feed, which will then of course enable your chickens to produce more eggs. Money allows us to break down the value of a good or service into smaller units of value that are easily exchangeable. Hard money. Precious metals that retain value over a long period of time are the perfect medium out of which to make money. But if you have sold 10 years worth of eggs and have saved up the gold coins it would take to buy a house, you would need a truck to haul all those coins to the seller. Hard money-backed currency. So instead, we put those coins in a bank where we believe it will be kept secure, and in turn, that bank issues a slip of paper known as currency as an IOU for the coins. Then, when we take those slips of paper to the seller to buy that house, it will be lightweight enough to easily carry around in our pockets. We hand over the currency to the seller, who in turn gives us a deed to the house to prove ownership. And the seller takes the currency to the bank. The bank then takes the gold out of our vault and puts it into the vault of the seller. We call these vaults bank accounts. In exchange for keeping our vaults of coins safe, the bank merely asks that it can invest a small portion of our coins to grow their own profit. Under the hard money-backed currency system, the value of money was tied to a specific amount of gold. Banks were required to hold gold in reserve to back the money they issued. This meant that the amount of money in circulation was limited by the amount of gold held in reserve. This is what is known as the gold standard. The gold standard system was still in place until 1971, but since then, America has been using a fiat currency system. Fiat currency. Fiat currency is the idea of just using the paper IOUs, as if it were the actual money and having no backing to it, except for the people's faith in the government that issues it.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today.
In this system, the paper currency can be printed at will, which almost always leads to hyperinflation, destroying the faith in the government that backed it. It is a system that has been tried many times and has always failed. If you want to know why, you have to understand full reserve and fractional reserve banking. Full reserve banking. This is a monetary system where banks are required to hold 100% of their deposits in reserve. So basically, the banks can't lend out more money than they have on deposit. This led to the creation of savings and loan businesses as a method of lending money for large purchases like homes.
Merry Christmas, you wonderful old building and loan!
The idea of full reserve banking was also advocated by some economists and monetary reformers in the 20th century as a way to stabilize the economy and prevent financial crises. However, the full reserve banking system is not widely used, and most countries have adopted the fractional reserve banking system instead. Fractional reserve banking. This is a monetary system where banks are only required to hold only a fraction of their deposits in reserve. So the banks can lend out more money than they have on deposit, which can really spur the economy. The problem with this system is that it increases the risk of inflation and financial instability. Similarly, when banks lend out more money than they have on deposit, they're creating more money out of thin air, which leads to inflation. Watch our upcoming video on inflation to understand more about that topic. Representative currency. One more type of currency you should really understand is representative currency. This is simply a transactable method in either a hard money-backed currency or a fiat currency system that allows for the easiest possible exchange between individuals in the market. Some examples of representative money are checks, debit cards, online digital wallets. Instead of large suitcases of paper currency, one slip of paper or allowing someone to directly withdraw money from your account to theirs in a digital manner is often used in current society. So it's important to understand that there is a difference between money and currency. Money helps you get what you want. It's a medium of exchange that is widely accepted in payment for goods and services. Overall, physical gold and precious metals are considered a good form of money because they possess many of the characteristics that make money useful as a medium of exchange, store of value, and unit of account. Currency, on the other hand, is like a specific type of money that comes in the form of paper notes and non-precious metal coins. It also includes other forms of banknotes, digital money, and assets like bonds and treasury notes. In a hard money system, banknotes are essentially IOUs for physical gold, while in a fiat currency system, they are only backed by the trust in the government and its central bank. Every time the central bank prints additional paper or digital currency, it adds to the supply of the currency while the supply of precious metals stays the same. In this way, the individual dollars in the supply become worth less of the amounts of gold and is known as devaluing the currency. Too much devaluing the dollar will then make it worthless. So understanding the origins of money and the different monetary systems can help us to understand how our economy functions today. If you want to learn more about the topic or want to know more about economics, please leave a comment and let us know. And remember, money might not buy happiness, but it does buy pizza, and that's pretty close.